Okay, so hi everyone for this very early session for the US time and a very late session for me here in China and a comfortably afternoon session for everybody in Europe. So just very, very quickly, this session came about as I embarked on this path doing money view macro and then turning towards ABMs as a way to do that, which is, I guess, not a very novel thing, but we wanted to do just money view by modeling balance sheets properly, dealers, and so on. And we showed some of this work already in Manchester and then more in Darmstadt recently with Kiko's organizing. Thank you, Kiko, for that. And then I felt, maybe I should understand ABMs better, and I looked for papers that could help me understand them, especially those ones that have to do with liquidity and finance. And I found Co-Pierre's and Preben's work, which were extremely helpful and meaningful for me to understand how people that do ABMs think about this. So I thought it would be great if we had a session together on this and introduce it to the MoneyView crowd. So without further ado, we can start. I think we can start with Preben and then with Co-Pierre. So Preben's paper is Financial Instability Transition Under Heterogeneous Investments and Portfolio Diversification, and he'll tell you more about it. Preben, please start. Let's do a 15-minute, and then we'll switch to Co-Pierre.
Perfect. Well, thank you very much, Alexander, for that introduction. I have some slides. Can I just share my screen?
You should be able to.
Yeah, there. I think that's just share. I think I'm screen sharing.
Yes. We
Uh,
see your screen. Yes, we see the.
I can't get to the. There we go. Oh my God, this is very messy. Sorry. Let me try. There we go. Put that away. Okay. I'm screen sharing. There. So thank you very much for that introduction. I'm Preben Forer. I'm a fourth year PhD student at King's College in London, a PhD in mathematics. And for the past 4 years, I've kind of been using network models and kind of agent-based kind of adjacent models of financial markets in order to study contagion through them and specifically heterogeneous portfolios. And so today I'm here to kind of thank you very much for the invitation, and I'll give you a little bit of background on what I've done and kind of some of the results we've generated. But I thought given that it's a bit of a different field, I got the sense kind of a more mathy kind of topic. I thought I would start with a little bit of a snapshot of network-based models of financial contagions. And so it's quite a stylized model, but one nice way to think about it is if you say you have M financial institutions, they have highly stylized balance sheets made up of assets and liabilities, and their assets are twofold. They have a portfolio of assets that they own and invest in on the markets, and there are N assets that they can pick to invest in. So think of stocks, for example. And then they have credit owed to them by other financial institutions. And these financial institutions, you can play around with the parameters, can represent banks, non-banks, insurance houses, or what kind of it's all very toy model-y. So you can play around with the parameters to choose to kind of make it what you want to be. And then on the other hand, their liabilities are simply just the money that they owe to other institutions. Oh,
Yeah,
sorry.
it's good.
Yeah.
I think
So
Asger was, yeah.
the liabilities are the money that they owe to other institutions in the form of these loans. And so with these kind of two forms of assets, you can create a network and a diagram kind of to represent it, where on the left we have the network of interbank loans, where the edges represent the loan owed by institution one to institution two, for example. And then on the right, you have a bipartite network where some set of nodes are assets and other sets of nodes are institutions, and the linking them represent ownership. And with these two networks defined, you can then study two kind of roots of financial contagion using tools from mathematics and network science. On the interbank loan network, you have what's referred to as solvency contagion, where the idea is that if one institution defaults on its loan, its creditors have less book value and it affects their balance sheets, and then that affects their ability to repay their loans. This is often referred to as direct contagion because the health of one institution directly impacts the health of another. On the bipartite network of assets, you have what's known as fire sales or overlapping portfolios, where the idea is that if one institution is faced with a liquidity crunch and it's forced to sell some assets in order to raise cash, oldest rule of the book, supply and demand, that if they sell enough, the asset prices will go down, which will affect the health of other institutions' balance sheets, which might force them to sell assets, so on and so forth. And this is often referred to as indirect contagion because now the health of one bank indirectly affects the health of another bank through an intermediary, which is the common asset. And that is the kind of the process that I've been studying for the past 4 years. So the key kind of question when studying fire sales is what network structures and what patterns of behavior encourages or discourage contagion from spreading throughout the overlapping portfolios. And a lot of interesting research has been done in this field. I highlight one paper by Coccioli, Ferrar, and Remedia from a few years ago, which is, as I said, you can play with the parameters to make the institutions refer to banks or non-banks or different things. And they found that the different regulatory requirements actually increased the instability in the system. Another big paper, and one that we based a lot of our work on, was done by Corsi, Marmi, and Lilo in 2016, where they developed a model, a stochastic model, the CML model, and they found that even though increased diversification leads to each bank becoming individually more stable, the increased portfolio overlap actually increased the likelihood of contagion spreading through the market. So, which is why they're very kind of witty name when microprudence increases macro risk. But one of the assumptions they made was that banks invested homogeneously across all their assets. If they were investing $100 across 10 different assets, then they would invest 10 in each, which is clearly not the case. And so the question we set out to ask was, does the manner in which institutions invest impact the stability of the market? Is this an assumption that's safe to make, or does heterogeneity in investment sizes increase the instability present in the market? So the model we used was we defined X, which is a random investment matrix, and its entries just represent the ownership, the investment of institution J in asset I. And X has one component, which is the investment indicator, which is either 0 or 1, with a probability that depends on a parameter Q, which is just the average number of assets a bank invests in. So if Q is 20, then they're expected to invest in 20 assets on average. And when you limit it to just this, you have the Corsi, Marmi, and Lilo model because you're either invested or you're not, and you're investing the same amount in each asset. So we then introduced a second kind of random variable into the investment matrix, which is the investment size K. And so we're saying, okay, given that a bank I is invested in an asset J, or sorry, bank J is invested in asset I, how much does it invest in? And we said that we just chose it to be bimodal, where banks can either invest heavily or lightly with a given probability. And so going back to kind of to give an illustrative example, going back to the toy diagram we had earlier, this is what one instance of that matrix X would look like, where the S is the small investment and is modeled by the light edges and represents that they own this asset, but they're not heavily invested in it, whereas B represents heavy investment. So with this kind of setup, we now have to define some price dynamics to study it. And so we're interested in studying the stability of the asset returns, so the vector R. And the asset returns have two components. The first one is a random exogenous component. It has a factor and some idiosyncratic noise. This is meant to represent the overall trend and the kind of day-to-day fluctuations of the noise. But from a stability point of view, it's kind of uninteresting to study because its riskiness and its volatility just depends on the parameters you choose initially. It kind of kickstarts trading by causing some price fluctuations, but what we're more interested in studying is the endogenous component, which is determined by trading at the previous time step. And this is our supply demand function. And we went for a linear price impact function where the price changes inversely proportional to the asset liquidity and then depends on the overall share of the asset being sold. So the total demand divided by the market cap. And since it's determined by trading, its volatility is non-standard. And so this is the thing that we want to study. And so when we go through and estimate the demand in an asset and the market capitalization in an asset, you kind of get this big formula. The details of the calculations are in the paper, which I selfishly recommend that you read. But you're able to write the assets endogenous returns in terms of a random matrix phi that multiplies the returns at the previous time step. So you get an iterative auto-recursive process. Now, what are kind of all the factors that go into there and how do they come into? I thought I would just give a little bit of an idea. So the eta is the regulatory target leverage. The difference with it between its actual leverage and its target leverage is what instigates trading. Banks have to meet their target leverage, and we say that they saturate the upper bound of how much they'll be allowed to have. So they always go to this leverage and this leverage amount, and it is set through a value at risk constraint, which is a fixed parameter that has a function that is also the kind of the details of which are in the paper. The asset liquidity, and it comes into play when we're estimating the demand in an asset because it is essentially telling you how much asset it needs to sell in order to meet its regulatory target leverage. Gamma is just a constant fixed parameter for its asset liquidity. The parameter alpha is its market structure, the ratio between the number of banks in the system and the number of assets, and it comes into play when we are estimating the market capitalization of the asset. And then now our price depends on the weight matrix W, which is a row normalized version of our matrix X, and it represents the proportion of asset I in institution J's portfolio. And it's still random because it depends on the initialization, but it comes into play when we're setting how banks trade. And the assumption we're making is that the banks are fundamentally happy with their portfolio makeup. And so they are only trading to reduce their total amount of asset to meet their regulatory leverage. And so therefore they trade according to the portfolio weights. So if Apple makes up 10% of their portfolio and they have to sell $100 in total, they'll sell $10 of Apple. And doing so keeps the portfolio weights constant in time, which kind of makes sense from that economic point of view. And then selfishly from a math point of view means because it's constant in time, we can apply tools from random matrix theory. And so now that we have this matrix phi, we're ready to study the impact of heterogeneity on the variance and the volatility of the price returns. And what we find is that when you iterate that process, ET is equal to phi times ET minus 1, you can link the stability and the volatility of the price returns to the largest eigenvalue, the average largest eigenvalue of the matrix phi, which is a number that encodes some of its, which is one of the key numbers and statistics that you can study in random matrices. And what we find is when this number is larger than 1, the volatility is unbounded and the price returns explode and shocks continuously propagate throughout the system. Whereas when the average largest eigenvalue is less than 1, there is still volatility in the system, but it is bounded and converges to a fixed point. So the question is now, what is the average largest eigenvalue of phi? And there are three methods to do so. You can use direct numerical diagonalization and find it numerically. You could approximate it, but this obviously gives an exact result. But when you're dealing with matrices of the scale of the financial system, it is numerically and unfeasible, really, in terms of computing power. So we need some analytical approximations. And the first one was to approximate it through the largest eigenvalue of the average matrix, which is what was used in the Corsi, Marmi, and Lillo paper. And this is a good first approximation, but fails to pinpoint the transition lines, which led us to use a recent result from the field of random matrix theory and to approximate it through an exact analytical evaluation of the average largest eigenvalue of an approximate matrix. So armed with those three methods, we now need a setup to study heterogeneity. So we define this kind of measure 1 minus S over B, which intuitively tends to 1 when the large investment is much larger than the small investment and is equal to 0 when heterogeneity is kind of not present in the system. And we keep all the parameters the same, but we additionally fix the first moment and the average of the investment weight. So we're saying that on average, you're still expected to invest the same amount as in the Corsi, Marmi, and Lillo paper, except now the manner in which you do so is differently. And this uniquely fixes and defines a point in the plane, which we can then study to look at the stability. So the first one we did, which was method 2, which was the Corsi, Marmi, and Lillo one, where you can evaluate the average matrix and the entries depend on the second moment. And using the matrix determinant lemma, you could compute the largest eigenvalue of this average matrix, which gives you a handy closed form expression, but as we'll soon see, fails to pinpoint the transition lines accurately. So that's what we've done here. And this is kind of the key key plot, one of the key plot, and kind of if you have one takeaway, it's this slide. So I'll spend just a bit of time explaining what's going on here. So here we have our phase diagram for two settings. The one on the left is when the number of banks is roughly equal to the number of assets. And the one on the right is when the number of banks is significantly smaller than the number of assets. And this is meant to represent the global systemically important bank setting, where the idea is there are only a handful of major money movers like the JP Morgans, the Barclays, and they have a significant order of magnitude more assets to pick to invest in. So those are the two settings. And what we've done is plotted the average largest eigenvalue and just kind of done a criteria of whether it's larger or less than one, so whether the system is stable or not, for numerical and method two. And the line in red is the actual numerical transition line. And the key takeaway is that it is there and it exists. That we've kind of answered the question that the manner in which banks invest does matter, because there is room on the phase diagram. There's places where the system is unstable purely because of the manner in which banks have invested. Increasing heterogeneity pushes the system towards instability and can finally eventually tip it over the edge and cause it to be an unstable system. So that's kind of the key thing, is that transition line is there, assuming homogeneous investment could lead to a misdiagnosis of the stability of the system. Now, how does the analytical method do? We
Mm.
see that it's got the yellow dotted line, and it only picks up the instability in the most extreme of cases. And so that motivated us to develop a third method where we approximate the matrix in terms of our matrix X, which is the initial investment matrix. And we fix the constant so that the first moments are equal. Now, it's a sparse matrix with independent entries, so we can use a method called the replica method and a result that we determined. And you can find the average largest eigenvalue by solving recursive distributional equations with a population dynamics. And so we then plotted it, and it does a much better job. It's still not perfect, but it does a much better job because it accurately predicts that increasing heterogeneity increases the instability of the system. And additionally, it misses in a better way in that it's overly cautious. If you listened to this this analytic approximation, you would only be in a false negative. I always get the two mixed up, but you would never be in a false positive where the system is unstable, but it's telling you that it's stable. It misses in the right way. But this kind of difference in the region, the fact that the global systematically important bank setting had a larger part of the phase diagram that was unstable, finally led us to the last analysis that we did, which was a connectivity analysis where we kept everything else the same, but now we just studied the impact of the average number of assets invested in Q on the stability of the system. And what we found was that there were two actually effects going on and tugging at each other. There was a stabilizing effect whereby the more diversified banks are, then the more banks and each asset has on average investing in it. And so each asset has increased market capitalization, which gives it a larger amount of depth to absorb trades. And so this is a stabilizing effect that is quite prominent at low connectivity. However, after a certain point, the benefits of this are diminishing, and the destabilizing effect found by Corsi, Marmi, and Lilo becomes stronger, and the increased portfolio overlap pushes the systems towards more instability. And this kind of explains why the setting in which there were fewer banks had a larger region of instability, was because each asset was then invested in by fewer ones, because the major players only invest in a few. And so that kind of, thank you, it brings me to the end of my 15 minutes of my talk. So thank you very much for listening. I hope you enjoyed, and kind of it gave you a snapshot into how to use mathematical tools to study financial contagion. And I just thought I would end by briefly highlighting kind of our contributions and what we did. The first, we built on existing network models of financial fire sales to study how heterogeneity in investment size impacts stability of the market. And this led us to an eigenvalue analysis of the price process, where we proposed two approximation schemes. But importantly, both approximation schemes and the numericals showed that heterogeneity does in fact impact market stability, and increasing it leads to increased instability and can force the system to transition to an unstable setting. We then finished with a connectivity-driven behavior where we found the two competing effects. Firstly, that increased market capitalization led to more stability, but after a certain point, the increased portfolio overlap led to faster and easier routes for shocks to spread, and therefore the system to be more unstable. Yeah, thank you very much, and I hope you enjoyed. And if you have any questions, please let me know.
Thanks, Preben. That was very insightful and interesting. We are going to first continue with the further presentations, and then we're going to get back to a general Q&A at the end. So
Perfect.
we are going to turn to Co-Pierre now, whose paper is the effect of the interbank network structure on contagion and common shocks. So Co-Pierre, if you can share your screen.
Yeah, I can share my screen. Yeah, thank you so much. It's a bit unusual to present a paper that has been published like 12, 13 years ago, but such was the ask to me. And I took it as sort of encouragement to think again about what we've done back then and sort of what have we learned in the meantime. And actually, the last presentation I found is one that I gave at an INET meeting. It's been some time
Right.
ago, so it did make me feel quite old when I was going through the old sort of material. But you can see my screen, right?
Yes.
Okay, cool. Then let me use it as an opportunity to tell you a bit about what we did back then and sort of why, and reflect a little bit on sort of how have things changed since back then. So I'm trying not to do the old guy rambling kind of thing. If I sort of drift into that, let me know. The motivation, I think that stood the test of time. Systemic risk is something that we have seen remerge again and again in different places and ways. Think about the Silicon Valley Bank and the sort of subsequent bailouts. There have been several episodes around the world where we had bank defaults that sort of were considered serious enough to warrant bailouts. Whether or not it's always appropriate is a different discussion, but it's still something that pops up as, something that builds slowly in tranquil times and then abruptly unravels in times of crisis. So there's an immediate time dimension to it, which makes it still very difficult to model in the way that sort of most microeconomic models would be built, which is like 3-date models or something like that, because there you can't have these two different time dimensions. So if we want to understand the nature of systemic risk as a consequence of an interconnected financial system, that's something that we still, to this day, I think, struggle with. And the second thing where we've made more progress as a... Sorry, my headphones are dying. Can you guys hear me?
Yep.
Okay, cool. Where we've made more progress, I think, as a community and also just, as a discipline is when it comes to understanding the cross-sectional dimension. This direct contagion, I think, is not as sort of prevalent in the trivial sense as we thought when I was a PhD student, simply because these direct interconnections are usually limited by large exposure limits. They are sort of typically internalized to some extent, and even if they aren't, the effects, if you do this ex ante internalization of these channels, are more subtle than what we thought. There was one great paper which came out a little later by Raj Iyer on sort of contagion among Indian banks, where depositors in a bank that was exposed to a defaulting bank would withdraw prematurely. So basically, what they find is that this standard interbank contagion channel exists, but it doesn't work through the mechanical accounting of losses. It rather works through the sort of more subtle incentives that depositors get when you have these interconnections in the financial system, which I thought that was quite interesting because it added a new dimension to it. Other challenges that I think we still have whenever we model systemic risk, and one recent application that I've been interested in is sort of in both decentralized finance and in crypto more general. It feels like crypto has forgotten pretty much everything we've learned about finance, and they think this time is different. So all the lessons that we learned the hard way 2008, I think we're about to relearn. So we still have that heterogeneous agents, complex interactions, dynamic structural change, deviations from rationality. I think they still characterize markets. And sort of one of the biggest open questions still in my mind is, what is the right model if we deviate from rationality? And even if we accept sort of a rational expectations benchmark, I think nobody will say this is exactly how the world works, but it's a great benchmark that we can use. even there, I think there's lots of remaining open questions, even like 12, 13, 15 years after this initial wave of papers sort of studying this. Yeah, so I think where we were back then is to say, well, you know, if we sort of ignore a little bit the conventional wisdom that you do like 2-agent models with rational expectations, and we say let's be inspired by what the problem is and try to find the best model to solve this problem. For me, that was the use of multi-agent simulations. Not to say that this is exactly how the world must evolve, or this is exactly how banks optimize their portfolio, because clearly it's a much more complex process that they are following. But to say this is an alternative benchmark that we can use where we hopefully can reasonably understand what's going on. The model that I then built, which by the way, nowadays, I think, and I reflect on this a little bit at the end, I think I would build it completely differently, or at least in a different way. But the model I built had these sort of 4 components. There was an environment where everything lives in. We had some dynamics that determine the updating of individual agents. And sort of crucially, it determined the equilibrium concept. And I think there was always a criticism that quote unquote mainstream economists would, or sort of orthodox economists would have of these models, is that equilibrium is not well defined. And that has to do with, I think, most macro agent-based models falling into, I don't want to say the trap, but sort of they impose rules on behavior where we cannot assure mutual consistency. And I think that's something that economists really cherish, that sort of mutually consistent decision-making as a reasonable benchmark for how we would like to understand the world. And back in the day, there weren't really a lot of good benchmarks for that. So what I approached this is to say, well, you know, the dynamics should be such that there's going to be rationing on the interbank market, because in practice that's how it's going to look like. But therefore, the price of interbank loans is fixed. But in this sort of model of endogenous network formation, you need to do one or the other. If you want to have a model where the market clears, the interbank market, you do need to have some rationing, or you do need to have some form of price adjustment. And Marcel Bloom, Yang Tran, and Esther Faya, and a couple of other folks, they then did the price dynamic version of it. The agents in my model were, you know, straightforward banks. I didn't really model households very actively, or, you know, the economy. Nowadays, you could do that, but then you would get like an even more complex system with sort of an even less clearly defined equilibrium concept. And I would impose a lot of structure, typically just studying stylized effects, where, you know, maybe ideally you would be able to calibrate a network, or you would be able to use bank balance sheets and household balance sheets and firm balance sheets to calibrate the agents. And actually, one of the reasons I joined Bundesbank after my PhD was because I had this hope that we would be able to use all that amazing micro data that they have on, you know, the portfolio of every single bank is very well known at Bundesbank across time even. So they have really granular balance sheet data. They have really granular securities holdings data. We had data on every single trade at every single exchange in Germany. At one point, we had full credit register data. So there's really granular data. I thought, oh, maybe, you know, with all that data, we should definitely be able to calibrate these kind of models. And the folks who did the systemic stress testing, for example, within the I think it's called the BEAST framework at the ECB, like they have tried to do that, but it is still limited because there's so many parameters, and many of the core questions about how banks actually behave, quote unquote, I think we still don't know. I think we know that the traditional Diamond-Dybvig world, or the Holmstrom-Tirol world, or that this is an illustration of a problem that exists in a very general set of models, but not necessarily so that this is what banks do. And on the flip side, there's very few models sort of studying the I/O of banks, even to this day. even when we were looking at alternative ways of how do we describe portfolio optimization, things like that, going back to the Klein-Monty model, there isn't really a lot of this alternative worldview on how should we actually consider how banks operate. And it's clearly at odds with when you go to a bank and you look at their decision making, at sort of how the analysts work with the risk management, with the management. It looks very different in practice, and there still is a huge gap, I think, in our understanding. And therefore, we don't have enough discipline on the models to really do a good calibration. I think that is sort of part of the pain. In the model, we had this sort of, you have the liabilities and the assets. Banks invest in firms. We would sort of calibrate this and sort of impose some conditions on risk aversion of households that would determine deposit holdings. We had this sort of large interbank lending and borrowing sector. There's the banking capital. There's liquidity provision by the central bank, and then there's excess reserves held with the central bank, and there's some shocks that would hit the system. And basically what we would do is we would impose a network structure. Back then it was just me randomly picking what the literature knows, but nowadays I think we would have sort of pretty good micro data, both from payment systems, but also from large credit registers that don't, many of the problems that we had back then about how does the interbank network structure look like, I think we have figured that out. We know at this point. It is roughly core periphery. I think of the stuff that Ben Craig has done with Götz von Peter. And so there's lots of papers of confirming this. We've looked at things like intra-group structure. We've looked at things like overnight versus term, secured versus unsecured. So I think we do know at this point quite a lot about how this network looks like. Where we still don't really know is sort of how to model the portfolio optimization of these banks. I think that's still a pretty much open question. So what I did then is that I said, okay, let's write code that simulates this, that imposes an algorithm where we would sort of solve the interbank network game, if you want, that updates balance sheets, and we use it to simulate sort of the things that we do care about, which is whether or not, a bank that suffers losses, whether it would be insolvent, and how that insolvency would then sort of spread to the rest of the system. And there was this loop, and basically in this loop, there was a way that interbank clearing would ensure that the bank portfolios are all mutually consistent. And I always thought that when I spoke with economists or my colleagues at central banks, that was one of the things they really sort of appreciated about the paper. The paper is so stylized, it doesn't make a serious contribution in that regard. But what it did was this sort of recognition to say, well, okay, mutual consistency is something that we should care about. And if we do, we get away with a lot of things like having a model with 26 parameters, which is normally is a big no-no because it's way too many parameters to calibrate. And to this day, it hasn't really been possible. We've looked at things like fire sales and interbank contagion, and later even in extensions at things like information contagion. And then we were able to just, simulate different scenarios. I'm not going to go through this in too much detail. Simulate these different scenarios where we then were able to say, this is the model parameter where the thing we care about, which is the number of active banks, actually reacts most sort of seriously. And you get some of these nice, interesting, non-monotonous sort of results as you sort of play around with the model parameters. It's then also a useful tool to study different policy proposals, which again, the central banks have taken up, and they were quite open to this. So to me, it seems like these kind of models are pretty much standard at every larger central bank is using versions of these kinds of models where many people have contributed to the literature, because simply we can study different policy proposals and see which one has the largest sort of effect. So just to end on time, I think we are at a pretty unique inflection point at the moment, simply because of the emergence of AI. The thing that was very expensive back then was not the simulation time. People always think, oh, I'm so smart and my code runs so quickly, so I only have to care about writing code that runs quickly. I always thought I'm not very smart and my code is going to be fine because computing power can always be added, but the development time makes up 90% of the time that I spend on a paper. Is very rarely is the simulation time, well, at least for the models I did, that took the time. With AI, I think we are at this point where we really could create these kind of models on the next level, taking into account more realistic structures, more realistic behaviors, building them in a way that is reproducible. In a way, oh yeah, what we did is we released all of this back then when I was still working with the folks at Captain. We released all this to make it open source. Nowadays, with reproducible pipelines, with sort of cloud computing being where it's at, with the ability to actually implement real agents, like agentic models, into a simulation-based environment like the one we study, with sort of connection to real data, I think we would have an opportunity to write papers that sort of solve a lot of the open points. So if I was a PhD student, I think that's something that I would try to sink my teeth in, because it's a pretty amazing time to do this, where the cost of computing and the cost of writing code in particular has just gone down so much. My model was like 100,000 lines of code, and it just took me ages to build it. Nowadays, I think you could build this in a week, and much better than anything that we did back then. So I think it's a very exciting time to think about these kind of models. And with that, I'm happy to have looked back in time a little bit at sort of these models, share what I've sort of learned along these like 10 years. Look forward to comments.
Thanks, Co-Pierre. Let me now share my presentation and try to go through it. You guys see this, right? Okay. So, the project here has been kind of following many Perry's insights that we learned over the years, whether through the course or his books and or papers, and to kind of try to build out a simulation environment that is going to align with what he used to do on the blackboard with balance sheets, and then also take up many of the insights that he developed on dealers, of money, and so on. So very quickly, the idea is that we have this multi-agent payment simulator that models liquidity settlement and default in networks of interconnected obligations. So the baseline is that we model agents as balance sheets that change over time. Everything on every balance sheet is instrument level specified, so counterparty, cash flow, maturity, and so on. So it's really focused on liquidity in that sense, rather than solvency or capital. Basically, we treat all the valuation methods that exist in finance as heuristics that potentially come into play in the decision making of different types of agents, but ultimately the liquidity kills you quick proverb is what we hold on to methodologically fully, right? So it's all about whether you ultimately are able to fulfill your payment requirements, otherwise you default, and then obviously there are procedures for that. Of course, beyond fulfilling your payment requirements, you can have additional targets, and they could be growing your balance sheet or making profits or whatever you want, and you could think of those targets in any terms of valuation. But this baseline of payments and cash flow is really crucial to us. The idea is that we have these agents, and they are going to have some kind of information channel where they observe some part or larger or smaller and differently defined on other balance sheets. And they're going to then do some amount of valuation and risk assessment with the tools that they set up to use, and they are going to make choices on a choice set that they are offered. And in this particular case, we wanted to work. This was a coincidence early on because the other big mind that has influenced me and inspired me has been Jan Toporowski, who often talks, and in my master program many years ago, talked about this fable that Kalecki had on mutually indented agents that simply owe money to each other and there is no liquidity in the system. And in principle, they're supposed to default. And then some amount of cash comes in. And since they're all interconnected with aligned maturities and in a ring, they are able to clear all these debt with each other with this single amount of liquidity. The point was that, yeah, you could have an amount of debt in a system and it could lead to a full clearing or a total default or anything in between, depending on the distribution of liquidity and the timing of payments. And of course, the size of debt. And so that's what we model here. We basically have initially a system of these mutually indebted agents that only have two potential assets. One is a claim on another agent, and the other one is cash initially. They have one liability, which is corresponding to this claim. So they are liable to pay another agent. And the system is defined in this ring structure. We only did this one topology. There are obviously many more, and we heard in previous talks a bit about that. The idea is that we have three parameters. One is liquidity ratio, how much liquidity is in the system versus the amount of debt. Concentration, so we have how concentrated is the debt, either very unequally or very equally or anywhere in between among these agents, and ultimately maturity skew. So are the maturities early, late, and are they aligned or they are misaligned across the system? So I could be owing you tomorrow, but the third person owes me in 3 days. So we have more or less alignment there. And then we have a couple of other things. I'll mention them in a moment. The idea was to do 4 types of runs. One is just a passive set of runs where we simply see whether the agents, what agents end up doing, right? This is quite automatic. They don't have many options. They simply receive the cash flow that they're supposed to receive, and then they either are able to fulfill their payment requirements or to default. The other one would be to introduce a dealer into this system, and we can set it up in a manner that it is comparable to the initial system in terms of the amounts of liquidity and this distribution of debt and so on. Another one would be to have a NBFI lender, so someone who lends from his assets, basically lends from an amount of cash that they have initially. And ultimately to do, and this was developed with Michael Lobach, we are writing a paper on this separately from this, because this experiment is really just an exploratory one. It might never even turn into a paper, or it might turn into a paper, but at a very late stage. It was really more to try things out. So with Michael, we were looking to figure out, and we heard this from Co-Pierre as one of the big puzzles of how banks make decisions on their portfolio and so on. And Perry has the idea that banks are ultimately a type of dealer of their own. So we model that, and I have an additional slide on that if you guys want to go into it more. And then we basically have this treatment, which is these 3 parameters, and we look at what ends up happening in terms of default rate. And this is the baseline. So let me just give you our results. So first we ran 125 paired experiments of having no dealer versus having a dealer operating according to trainer model. That as well if we need it, 100 agents. And so what we ended up seeing here is that the in principle dealers help, and that this depends on a number of things. If there is temporal mismatch, then the dealers, basically the dealers need time before they're going to be able to help the system, kind of obtain liquidity at right points at right time. So if there is a loaded debt, then there is simply a contagion and a lot of defaults. Versus if there is like a more aligned across time debt or backloaded debt, then they're much more useful. Concentration and maturity. So equal debt, late maturities, yes, the dealer impact. And in principle, dealers never hurt. And then we did a bigger simulation that we didn't still finish. It's a pretty kind of recent thing where we had the dealer, we had the lender, we had also a bank as a dealer, and here we were observing things. In the view of time, I'm going to not go into detail here. We can talk more if you're interested. The future of this project is, on the one hand, to kind of basically to endogenize a lot more of the decision-making model for all these agents based on both the parameters of the run and also what ends up happening in the run, so that they basically update more of their decision-making variables that are relatively fixed. That was just the initial way we did it. And then also to introduce, like additional bits to their decision-making. What I also wanted to show you is what are some of the things that we still haven't been built, but we are looking to build. We are interested in building out more entities, simply like central banks, also introducing external debt to this system and alternative currencies, so we have a more complete monetary hierarchy. Other topologies, collateral. We definitely want to see collateralized lending and repo dealer rather than a spot dealer that we have now. And also equilibrium. So we have also been looking into having a price equilibrium analysis where we basically see to what extent, in what ways, and under which conditions dealers end up quoting prices in a stable manner over periods of time. So we do have some ideas about how to introduce more robust equilibrium analysis here. Okay. I'm going to stop since we have only 10 more minutes and we can open for questions. Maybe we can collect. So I guess maybe the best way could be if we had some kind of raise of hands here. Okay, so we have Perry. Perry, maybe you can go first and then we can get others as well.
So these are wonderful, interesting papers. Okay. Maybe as a preface, I will just you were was it Preben or was it he was he was afraid that he was rambling like an old man. Well, I'm an actual old man, so let me tell you that I started. You probably don't know that. Blake LeBaron, had the agent-based model, and I tried to add credit to it. I spent a whole 3 months doing this, and it kept blowing up. Okay, and instability, like the eigenvalue is greater than 1, that sort of thing, and my conclusion from that was that I needed dealers, that I needed trainer model, people who were, stepping in when prices get out of line and they're buying or they're selling. And so they're a stabilizing factor, which is what Sasha is emphasizing. I think the first 2 papers are mostly settlement constraint. They're worried about runs and so forth. And but the stabilizing factor is the dealer. So the trainer model was what I grabbed onto, as a consequence of my failure in 3 months of writing code. This was, I don't know, 30 years ago, I don't know, 25 years ago, Blake LeBaron. And so I stopped doing that, and I do things on the chalkboard kind of instead. The So what I would appreciate here. So Preben and Co-Pierre, as far as I know, you're because these are bank models, right? You don't have other agents. You don't have agents who are fundamental agents who are thinking, what is the value of these assets? Should I buy? Should I sell? Something like that. And there are people like that, okay, and there are also dealers who don't really care about fundamental value. They just care about flow. They care about order flow. Is the order flow, which I'm sure you work at Deutsche Bank, that that is. So my question, maybe, or maybe it's a comment, is Deutsche Bank a dealer? Is Deutsche Bank a dealer? Or are they? I think that's kind of important in the United States, because after the financial crisis, banks were prevented from being dealers, right? They were just supposed to be brokers, right? And so that all moved into the hedge fund world, where it's the hedge funds that are kind of dealers now, not the banks. But perhaps that's different in Europe. I don't actually. I think this is very important. So there are two ideas in the money view, only two. One is the settlement constraint, which you guys are completely on board with, but the other one is that asset prices are formed in dealer markets, and that is, Sasha is focusing on that, and so I think the second idea needs to be there. Because if you're trying to liquidate something, if you're trying to sell something to make your payment, you need to sell it into a market. So the dealer function is, I think, more central than I'm hearing in this. But I'm very, very happy to see that people are I failed at this, agent-based modeling, and so I'm glad to see that other people are carrying it forward and maybe having more success than I did.
Thanks, Barry. Maybe let's get a couple of more comments. I see Asger's hand. I don't know if anyone else wants to comment, and then we'll just have a final response from everyone.
Yeah.
Just before Asger starts, are there others who would want to speak as well? I'll get you. Okay, Asger can start, and then we'll see if you can.
Yeah, thanks a lot. I love this exercise and seeing the math and sorry about the name, and the Co-Pierre. You should know that me and Dan Nilsson, we tried to do some mathematical modeling like 10 years back or something. But when my son was starting his mathematical with quadruple, so we should try to repress that. But like, yeah, fascinating to see this going, and then with AI programming, I see a brighter future. So I just had one idea on top of Perry's comments for addition or like challenges. From the fire sale perspective, this is coming from Iceland, where I'm sitting. The time factor is so important, and it's also the Swedish banking crisis in the 90s. So Stefan Ingves, the recently bank governor of Riksbank, was in the 90s head of a state-owned entity that took care of all the fire-sale real estate assets that were bankrupting the system then. And then he was the central bank governor in the financial crisis and took, for example, the Kaupthing Bank from Iceland in Sweden over, sold it to Ålandsbank. So the whole of the fire sale issue was covered by just like with legal entities, bankruptcy estate that hold them for 5, 6, 7 years and recovered all the money and paid the state even back. So the Icelandic state didn't lose money on the banking crisis. I mean, a lot of people lost, but so like when you are modeling further, maybe I'm off topic here, but like it's easy to think about fire sale or contagion and in a crisis system, but that's like a simplified view of fire sale in model wise, but in real life, in real term, this can be told. And from another side, another story from the crisis in Sweden, when you had a fire sale on one huge real estate portfolio from Australia that owned the headquarters of Ericsson, they changed the accounting rules because all the real estates in Sweden that were owned by funds or with lending from banks had to be devalued after this one fire sale of one asset that went down in price. And then the accounting rules were decided on some secret meeting. If you hold it to maturity, you don't have to book it on book value. So you don't have to lower the asset value on your balance sheet because it's generating cash flow and no problem. So this is, you can change time either by holding the fire sale assets in a estate, or you can change how you account for it, and then it's not triggering a fire sale contagion. So, but yeah, but it's just to make life more complicated, but fascinating that you're doing these things. And sorry if I went.
I don't know if anyone else wants to comment. Otherwise, we're gonna have final words from Preben, Pierre, and me. Okay, let's go with final words now. Preben?
Yeah, thank you very much for the feedback, both Perry and Sigurd. I completely agree. I think just as when I'm doing a PhD in mathematics, and I remember when I told my supervisor that like this is kind of the work that I wanted to look into, he said on the first day, I'll never forget, he said, just be careful, you're doing a PhD in mathematics and not computer science. You need pen and paper results, chalkboard math, as Perry said. And so I think like I fully acknowledge that I think that's a big limitation of network models of financial contagion versus more kind of fully agent-based ones, is that in order to keep the mathable, you have to make some simplifying assumptions. And I think I completely agree. If you can't say that the prices just keep falling, because eventually a dealer will come in and buy it. But in incorporating that element then becomes more agent-based modeling, which I have a paper coming out hopefully soon with the Bank of England, which was a purely computational agent-based model of financial fire sales, which incorporates different kinds of behavior, different kinds of trading strategies, and kind of you could just go, okay, forget ever having to solve this analytically, but it then kind of provides you a little bit more guidelines. And the idea behind that one was then to use that highly detailed model to then study what is and isn't important, and then simplify everything else to then do a math model of that just kind of focuses on one thing. So yeah, I don't know if I'm now rambling, but I completely agree with you that there are things that needed to be added to make it more realistic, but it's approaching it from two fronts. We took a paper and we took a model that made one assumption that we thought, you know what, we can definitely simplify this we can definitely take this assumption away and the simplifying assumption away. And we kind of did that. And so then the next step I don't know, I'm finishing in a month, so I don't know if it'll be me, but hopefully someone then in some young PhD student in 2 years will look at my paper the way I looked at Corsi, Murmy, and Lilo's and go, oh, well, maybe we can simplify, we can get rid of this assumption as well. So, and then from the other side, using highly detailed agent-based models to then identify what's important and what isn't, and then guide the math, if that makes sense.
Yeah, I went the opposite way. I started more simulation based and then moved more towards the mathematical models simply because I think it is really appreciated in the journals more than I think in the practical impact. For when you speak with central banks, I think they very well. They just want to know what's going to happen, like how robust is something, where should they watch out for emerging risks that they wouldn't see otherwise. They don't care if it's published in Econometrica, JF, or JDF. They just want it to work. It's a little different if you're sort of a young economist fighting for tenure, then you do want to sort of thread that needle a little bit, I think. And so I was led astray a little bit more towards the more mathy kind of models. With that being said, I think there's one thing where I thought there's like a really great impact that the ABM and sort of dynamical systems, I should probably say, community had on economics, and that is when it comes to models where you cannot do comparative statics anymore. Economists love comparative statics for a variety of reasons, but whenever you have sort of discontinuous changes in variables, because, for example, there's kinks in best response functions or other reasons, then it just doesn't work anymore. So the question is, what tools can we offer to still say something about these important models? And just something that comes to mind is multi-layer networks. With Ben Golub, I had a paper together where we looked at that and looked at sort of percolation processes in multi-layer networks and see sort of when they emerge. There is a more general type of model out there that we haven't quite found or studied or cracked, but there is sort of there's math out there that I think is genuinely appreciated by economists. So Ben had another paper where they did the same kind of thing in a supply chain model, and that was published in AR eventually. So, like, I think that there is something on the horizon where we can use this dynamical systems insight into models of economics that people genuinely care about and tell them, by the way, we can tell you something about the areas where you usually just navigate away from. We don't have to stay away from the corner cases anymore because we can still tell you something even though there's a discontinuity. I think that is very exciting, and I think for me that's sort of if for sort of young folks going into this, I think this is something super worthwhile. Like this intersection of we take models to understand sort of the practical stuff computationally, but then we actually take it and try to solve the math generally and say something about like a general alternative approach to this. And yeah, that I think is still a very open question that's on the horizon.
A final word from me. I just wanted to say that with Jay, we were thinking about doing a bit of a boot camp on these kind of simulations, possibly in June online. So we'll see how that all pans out, but you're going to receive information and we'll see if we can assemble a group and work a bit this kind of money view modeling and address different types of problems with regards. So please keep in touch and thank you.
Can I